Banks are about to stop lending. I'm your host, Steven Van Metre, and thanks for joining me today. And financial conditions are about to get even tighter as the yield curve inverts, threatening the banks to curtail their lending. And I'm going to show you why and what this means. But let's head over to this headline first. It says the rest of the yield curve is screaming that the Fed is about to commit a major policy error as 3.5s, 3.10s, 5.10s, 7.10s, and 20.10s are now inverted. Now, what does that mean when you hear this term inverted? Well, I'm going to walk you through the charts, but I want you to understand a little bit of this before we get into it. The banks lend at short-term or borrow at short-term rates and lend at long-term rates and make money on the spread in between. So as you see the short-term rates and long-term rates get closer together, bank profit margins go down. And when they invert, when short-term rates are higher than long-term rates, well, banks can't make any money, so they stop lending. So let me walk you through this, and then you're going to be blown away when I show you just how bad this is going to get. So let's take a look at this first chart, which is the 3.5. So what this means is we're taking 5-year yields, subtracting 3-year yields, and when it's below the black line here, the zero line, it means that 3-year yields are higher than 5s, and that doesn't actually make much sense, and that's what the bond market is telling us. And notice here, you see I circled all the times it's been inverted, and notice what's next to it every time is this gray bar, which is when we have a recession. And you can see here, and we'll see the same thing in all these charts we're going to look at, is if it wasn't for the pandemic and all the fiscal and monetary stimulus, we would have had a recession probably in 2020 anyways. Now, this morning was inverted, and so you can see it's very close to, and this is going to dance around day to day, but we're seeing the early signs now of inverting. Let's look at the 3.10s. Now, what this chart is telling us is 3-year yields this morning were higher than 10-year. Can you imagine? You know, you're going down and maybe buying a CD or something like that at a bank, and 3-year rates are higher than 10. It doesn't make any sense. It shouldn't make any sense, and that's one of the challenges here. But look, we see the same areas are circled, indicating that when you get near or have an inversion, a recession is coming. Now let's take a look at the next one, and we see the 5.10. So 5-year yields also higher than 10. And again, every time you see when we get to near or have an inversion, what comes next? A recession. And again, it has everything to do with bank lending. Now look at the next one, 7.10, which has been inverted. So the 5s inverted this morning too, and appear to be staying there. And now we see the 7.10s, which we talked about earlier this week, still inverted. How about the 2030s? So 20-year yields are higher than 30. Now it's not unusual that this is inverted. If you're wondering about the gap, there was a period where we didn't issue 30-year debt because we were running budget surpluses. But again, you're seeing across different parts of the curve, you're seeing these different inversions. Now, this is really important because, again, it gets all tied back into bank lending. Now, when you hear someone in the market, maybe an expert or someone talking about the yield curve, they're specifically referring to the 2.10s. And now we're going to look at that one next. And it's not inverted yet, but this is what the market looks like at the most. So if you read an article or you're watching something that's talking about the yield curve, this is the one they're referring to. I wanted to point out that just how much damage is going on to other parts of the curve. So here we see the 2.10s, the 10-year minus the 2-year. And again, similar story. When it gets inverted, recession is coming within a year or 1 to 3 years, sometimes less. And here we see it's not inverted yet. We're getting close, but we're not there yet. And this makes a huge difference, as you're about to see. Now, if you are looking for an investment strategy that is kind of designed around this concept, hedges with bonds, as you're about to see why it does this when we go through these slides of what matters with bank lending, well, be sure to check out Portfolio Shield. I'll put a link up here in the corner in the description below, and it'll make a whole lot more sense when we're done, and you'll be glad you took a look at it. All right, now let's look at bank lending, because if everything that I'm telling you is right, when we see these inversions, what we should see is bank lending go down. And what that means, and I want to give you a little preview of what's coming here, is where is new money created in the economy? Yeah, right, when commercial banks lend. So if we're not seeing commercial banks lending, and that means financial conditions are tightening, and then you tack on inflation on top of that, well, you've got a recipe for a recession at best, or financial crisis more likely. But let's take the yield curve, the 2.10s that we just looked at, and we'll overlay loans and leases and bank credit in red on a year-over-year basis. So what we should see is what we're seeing right here, is when the curve inverts, we'll go back to 1980, and and we see it's coming out of the inversion, so it's rising higher. And what do you see with bank lending? All of a sudden, it gets crushed, and then you see it get crushed again. And notice here, we see an inversion. And so what happens? It comes out of the inversion and the yield curve is rising, and look at bank lending. It goes down and is negative. Now again, it makes sense, because if 2-year yields are higher than 10, banks can't make money, so they don't lend. But that's not the whole story here. That's just part of it. Let's continue and look at these relationships. Looking at going to the dot-com bubble, yield curve inverted and then went up, and look at that, bank lending down and negative, contracted. Here you see going into the great financial crisis, the bond market knew this was coming well ahead. Yield curve inverts, goes higher, and look at that, bank lending completely crashes because they can't make any money. And you see it here again going into the pandemic. We had a near inversion, bank lending goes down, and now we're seeing again, just as bank lending is getting back to normal. And now why does this matter in terms of what's going on with the banks? Because what I want you to see on this next slide is when you make a deposit at a commercial bank, they have to pay you interest. Now, I know that happens at other banks, but we're focused on the commercial banking system here. So how does a bank generate the interest to pay you the interest that you need? How do they do that? Well, they lend your money out. But what if they don't have enough demand for loans? Where do they get the money from? Well, they buy treasuries and mortgage-backed securities. They buy interest-bearing securities with your money. So you're like, well, I don't like treasuries, or I don't like mortgage-backed securities. Well, if you have money deposited at a commercial bank, your money is being used to buy that, I can assure you. So there's two things the banks can do. One, they can go out and buy the securities to fill the gap, or the Fed can come in with quantitative easing and force them to buy those securities. And that's what quantitative easing does. Now, as you already know, quantitative easing's over. I mean, they're reinvesting the interest off of it. It's not a major deal. And they're threatening, the Fed's threatening to do quantitative tightening later this year. Now, I want you to look at this gap, because now it starts to make sense. And I didn't fill the gap with the existing QE or the Treasury securities and mortgage-backed securities the banks own, but I want you just to understand the gap. So when there is a gap, and there still is one, if I were to fill in and add those on, that we would still see there is a gap there, meaning when bank lending seizes up and goes down, deposit growth still occurs. So what has to happen now? Do you get it? Right. The banks have to do what? Buy more treasuries, buy more mortgage-backed securities. And what does that help do? It should cause rates to go down, right? Makes perfect sense. So on the next chart, we're going to look at that yield curve again, the 210s, and I'm going to overlay 30-year treasury yields, because I want to show you what happens with the bond market. But that's not the whole story about what's going to happen with the bond market coming soon. Check this out. So you can see when we see these inversions, and we see the yield curve rising, look at what happens with 30-year treasuries. They go down. Here you see the inversion. And what happens? It inverts and the yield curve rises, and 30-year yields go down. And what is the popular view on interest rates right now? Yeah, they can only go up. They're only going to go up. And the yield curve is telling you, no way. They're going down. And isn't this interesting, a time where you see speculators are mega short the bond market, you see computer algorithms short the bond market, and you see money managers that have stripped out all the protection of their portfolios. You see retail investors that have run from bonds as fast as they can. And what is the yield curve telling you is going to happen? Right? Interest rates are going to go down, because what's happening when this blue line is going up, what you can't see here, because I didn't want to put too many lines on the chart, is that 2-year yields are falling faster than 30s. So when you see these inversions, again, yields go down. Inversion, and then it rises, yields go down. You get a financial crisis here and they crash. You see almost an inversion, and then it rises, and then you see interest rates go down. So now you understand that what's happening here is the banks are buying more bonds because they can't lend as much, and they will raise their lending standards to the point where they will curb their lending ability only to their best clients who can pay back their loans with absolute certainty. So you have banks buying loans or bonds. Now, on top of that, if you remember from previous shows, when we're in periods of high consumer prices, what else happens? Well, we get a lot of foreign imports into the U.S. And what happens then is dollars get exported out. And what do foreign countries do with those dollars? Those foreign producers, foreign central banks, foreign commercial banks, what do they do with those excess dollars? Well, they buy treasury securities and mortgage-backed securities as well. So all of a sudden we know at auctions, that's why there's demand there. So now you have demand from commercial banks here and foreign banks and central banks outside the U.S. And should we tack on another thing for the bond market on top of it? Well, due to the fact that we didn't get the Build Back Better plan, and maybe we will, but the federal government ran a surplus in January, and the deficit is not projected to be as big. So the U.S. Treasury has been scaling back the monthly Treasury auctions and is projected to scale them back even more. So now we're having an issue where there could be a lot of demand and not a lot of supply. And what this means is when you see the yield curve inverting or near inversion, and during a period of high consumer prices, you know the probability of recession? That's right, my friends. It's 100% probability. Well, I'm sure maybe 99.9. But with that, I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now. The content of this video is provides educational information only designed to provide investment advice. It's generally not to be construed as recognition or solicitation by a security financial instrument or participating in particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity, opinions expressed in this video that do not affect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.